G'day everyone, and welcome to episode 69 of the ScaleUps Podcast. I'm your host, Sean Steele, and you are very lucky because you've got me 2 weeks in a row. I am on a mission to help you fulfill the potential of your business so you can maximize the value you can create in the world whilst fulfilling your personal ambitions. You know all that. You, on the other hand, are a motivated 7-figure founder looking to scale up to 8 and beyond. And that's why you're here. And if you're like most of the founders that I support through advisory services like my growth mentoring or advisory boards or our courses, then you haven't built a business bigger than the one that you're leading right now. And so whilst things are probably going well for you in your business, you know that the business has got heaps of potential that you haven't been able to tap yet. And you're also aware that you don't know what you don't know, which is why you're here and looking for practical how-to type guidance, strategies and a bit of inspo along the way from our guests. Well, that is exactly what you're going to get today. Welcome to 10 Minute Tuesday, which is the episode style where I unpack some scaling principles, tools, and strategies to help you think about how to fulfill the potential of your business. And today we are focused on capital. If you are in need of some cash to fund your business growth, your big dreams, your big, hairy, audacious goals, your BHAGs, then you're in the right place because this week I'm going to share 14 different ways that you can get access to some growth capital to help you grow. And why 14? I have no idea. It must be a thing. Because last week I also did 14 ways to optimize your cash flow. Quite a different thing. If there's some significance to that number, maybe just drop me a comment in LinkedIn. I would love to know what it is and why I'm on a 14 roll. Anyway, I'm going to have a look at 4 categories today. Free sources of money. If you could see my fingers, I'm like doing the air mark, quotation marks in the air because nothing comes without expectation. So free sources of money, debt and equity blends, and even some early stage options. So there's lots to choose from. So what I'm going to do today is I'm going to give you an overview of the 14 different options so that by the end, you can ask yourself some good questions to help you figure out which options might be suitable for you, or that at least you'd like to spend some more time understanding. This is absolutely not a 3-hour monologue with heaps of detail around everyone. It's an overview, right? This is like 10, 12 minutes or something like that. And just as a disclaimer, this is just me sharing my perspective. It is a general overview. It is not financial advice. Please seek out solid, personalized financial advice and don't ever take financial advice from a podcast. Make sure you get what you need. Okay, let's get going. Let's talk about free sources first. What I meant by free, they don't involve any debt or giving up any control of your business like equity, and nor do they require repayments generally. They're given in exchange for you delivering something. Like most things, obviously you need to consider the risks and rewards of each approach, but the first one is grants. Grants, some people are just awesome at getting grants. They're usually funds provided by government agencies or private foundations, and they're usually focused on helping small businesses grow. They're usually non-repayable types of funding, but there's always, of course, constraints and expectations. At the same time, competition for them can be fierce and the application process can be pretty time consuming. So that's option 1, finding grants. Option 2, customer funding. Lots of people never really think about this one. But if you've got a customer who wants you to develop a product or a service for them that's actually quite niche and maybe even expensive for you to create, using a customer funded model might be a viable alternative for you to fund that. So it works by them obviously providing some funding for you to do that development and you giving them some exclusivity or bonus in return for them funding the development. And so on the plus side, that can be a great way to fund new products and services that you can eventually use for the open market, but perhaps they've got an exclusive period. On the other side, of course, if it doesn't work, you can have an unhappy customer or maybe even lose a customer, which is obviously not ideal. Okay, so that's a couple of free options. Let's talk about debt options, and debt and equity options are the ones that people would be most familiar with and most common. First debt option, it's going to sound a bit out there, but property loans. Now, I'm not telling you to go and put your house on the line, but typically the cheapest interest rate that you can get on any debt is an equity loan secured against your house. Okay, right at the time of recording, interest rates are a little bit high. For those of us who've been around for long enough, they're not really that high. But for the younger people in our businesses, they've never seen an interest rate north of 5. So they're going, wow, look how big these interest rates are. If you own a home, obviously you can use that to help fund your growth, assuming that you're allowed to use the proceeds of the loan to fund a business investment. So that you have to check that, of course. And clearly, this is a big risk, right? You could risk losing your home if you're unable to repay the loan, which would not be a great outcome. But the reality is, if you don't talk about it, I mean, let's be clear, lots of entrepreneurs have funded their growth, particularly in the early days, through equity loans on their houses. It is one way to access some funds. Okay, second, standard old bank loan. You borrow money from a bank, you pay it back with interest over a set period of time. That can give you some reasonably competitive interest rates, sometimes reasonable payment terms, and it's often pretty easy to get for established businesses. Keep in mind, banks love security. They are super conservative. So don't be surprised if they want, personal guarantees and security over your home and so on. And they also often require a lot of documentation. So perhaps using a broker might help you speed that process up if you're going to go down the bank option. Okay, now let's have a look at equity options. And then we're going to come back to some different models that are a bit more of a blend of debt and equity. Equity options, crowdfunding. It's actually a pretty popular way to raise capital through small investments from a large number of people, like customers or the potential end user, through an online platform. There's usually some kind of a reward or a premium deal or an incentive for any amount that people fund. And it's a great way to attract dedicated and loyal customers to kind of raise money from your fans, right? It can be a bit tricky in B2B businesses where you don't have a lot of customers. It's certainly far more attractive, I think, to B2C businesses or B2B businesses that can actually attract a super wide audience. I've made investments through crowdfunding. I've angeled into a company that's done a second round through crowdfunding. It's absolutely become, I won't call it the norm yet, but it's certainly become accepted. The platforms are far more mature, things like Birchal and others in Australia and many in the States. However, it can be a bit tricky sometimes to get enough backers to reach a goal. So that can be a bit of an issue because the funds that you're raising might be like $50 or $100 or $500 or $1,000. So you might need a lot of them. But I certainly have seen investments anywhere up to $50,000 on a crowdfunding platform. Okay, preference shares. These are kinds of shares that often involve giving investors a fixed dividend, which might be a bit higher than the common shareholders get, and priority over other shareholders in relation to, if there's a liquidation, in relation to proceeds from any asset sales that might happen. So it also can give you a more stable form of kind of equity financing. The fixed dividends, of course, can be attractive to the investors, but like other equity instruments, fundamentally it dilutes the equity of the existing shareholders, and the terms of the investment can be pretty varied. Employee stock options. Not usually a way that people will try to raise capital. Usually they're using it for incentive alignment, but fundamentally you're giving the employees the option to purchase company stock at a discounted price, which means it can bring capital into the business by having people buy in. It can, of course, just be used as incentive and rewards where they're not really sacrificing any cash or putting any cash in. That's quite often effective in aligning your team's interest with yours, but the accounting and tax implications can be pretty significant. So if you're trying to use it to raise real capital. So it's not the simplest option. They have become more simple over time. They have become more standardized over time. They're not right for everybody, but that's an option. Okay, private equity. This is basically an investment that's made by a private equity firm in exchange for ownership and a stake, an ownership stake, I should say, in a company. The firms, so the private equity guys and girls are raising money often from institutional investors or high net worth individuals to pull into a fund. And then they use that money to generally take a controlling stake in a business. And their goal is to scale the business up. They usually have like a 3 to 7 year exit timeline. And given that timeline frame focus, it can be a pretty high pressure environment. They want to get in and they want to get out. So they are really usually trying to pretty aggressively grow the business in that time because they're not long-term holders. They're not passive. They're not long-term holds. They've got a real defined timeline. So that can be excellent if you want to create a strong momentum towards an exit. But if you just want long-term sustainable growth without any pressure, that's may not be the right model. Joint ventures. People have heard about joint ventures, but maybe haven't thought about it as a way of kind of raising equity or diluting risk or bringing in talent, or skills or expertise. And that's basically where, you've got two or more parties, they agree to pool their resources to fund a specific project or company. I set one of these up in the Philippines a few years back, and you're both essentially providing the capital to fund the operation based on the percentage of equity you hold. So if the thing's going to cost $1 million to run for the next 2 years, and you've got a 60-40 split, somebody's putting in 600, somebody's putting in 400. And you're sort of budgeting together, you're approving that together, you're both sitting there on the board together. It's kind of like a long-term marriage, right? So the downside is that it can be a bit difficult to maintain control over the direction of the venture. So you've really got to have a calm, trusting, open relationship with good ways of solving any conflict or any points of tension, because you're going to be pulling your resources together. And so alignment and communication are absolutely critical if you want to make a JV work. Many founders will have heard of an IPO. An IPO is an initial public offering where a private company becomes a public company, making its shares available to the public for the first time. It is really suited to businesses, I would say, the majority of the time, who've got really sound and predictable revenues. It can be a really interesting option to head towards. They don't necessarily have to be profitable. Of course, if they're a tech company, then probably don't need to be at the starting point, but there needs to be a path towards profitability. And why would you do it? I mean, it can provide you with larger amounts of capital, also better liquidity for the shareholders. So if you're able to buy and sell your shares more easily, notwithstanding The public very interested if directors are selling shares as to why. So yes, it's more liquid, but still question mark as to how easy it is to get the money out, depending on how far down the path you are. And it can certainly raise your profile, but it can also be very time consuming and costly. I was chatting to Matt from XPON the other day, who's got a public listing, and I think he said it probably costs about $1 million a year at least, and that doesn't include the initial setup cost, which will probably be that plus because you've got investment bankers and all sorts of professionals involved in going public. So not the simplest thing. And if you've got a really lumpy business model where you kind of profitability comes and goes over time, not a great model for a public listing, generally speaking. Okay, let's talk about some debt equity blends. Therefore, a little less vanilla, and they start to become pretty interesting. So convertible notes, you may have heard of convertible notes. They are essentially like a debt instrument that can be converted to equity at a later date, usually when the company raises additional funding. So the debt is accumulating interest, and at the end of an agreed period, you're paying the investor back their cash plus interest, or they can convert that investment to equity at a discount to the valuation at that time. So let's just say they want to loan you $100,000, or they want to invest $100,000. They're either getting an interest rate on top of that 100,000 at the end of, say, 2 years or 3 years tops, probably. They can have the 100,000 back plus the interest repayment, and you owe it to them, or they can convert that to equity in the business at the time, based on its value at the time, but with a discount. It can be a really interesting model because it can provide you instant access to the cash. Of course, the interest rate is going to be higher than you would typically get from bank debt because the investor is taking more risk. So convertible notes are certainly becoming more and more common. Venture debt, not that many people have heard of venture debt or probably have had exposure to it. It's typically provided by a specialized lender to founders, often who've already raised capital. And it's like a 2 to 4 year term loan with a fixed interest rate. And that may also have an option at the end of that for the lender to purchase equity in your business. So it's not just a term loan. It actually has usually the option for them to purchase equity. Maybe not mandatory, but an option. And that can give you access to a kind of non-bank, fast to access solution that's probably going to be cheaper than raising equity and with greater flexibility and less restrictive covenants probably than a bank. Being mindful that the interest rates are going to typically be higher than your bank options. The last two for you are early stage options. So lots of you who are listening are probably not in this category and probably not going to be interested, or it's not going to be relevant. However, I do know a lot of founders who have ended up spinning off a new entity, a new company, because they've got a software idea, for example. There are ways to capitalize that entity differently and treat it differently to the core business. So if you think about what angel investing is, that's typically an investment provided by a high net worth individual in an early stage business as an exchange for a stake in the business. But quite often then you're receiving additional support or mentoring from those investors. They're pretty active generally. They've got a lot of experience usually. They've often been very successful, and they will usually seek to help because their money's inside your business. There's the potential for pretty reasonable check sizes. Usually, 20,000 to 50,000 might be pretty common for angel investments. Venture capital. Getting VC money is not easy, no matter how many success stories you've heard. And if you've ever met anybody who's been on the VC trail having to raise money, it's pretty rare that it happens quickly. Like the general model is that it can take a significant amount of time. And you've got to think about why. That's not because VCs are bad people, not in the slightest, but they're taking a significant amount of risk. They are usually making a pretty big bet in an early stage company, and they don't want to lose their money. So they scrutinize a lot of deals to find the ones that they are going to back. And so you've got to ask yourself, if you're going to go after VC money, have you succeeded in a similar venture before this one, like in a similar style of business? Do you have a strong and a backable team that they are going to believe in? Is there at least $100 million valuation opportunity in this business based on the market size you're going after and the business model? You might know your industry, but are you willing to do the 70, 80, 90 hours a week to make it work that they would expect? If you're a 40 or 50-year-old founder with a family and you're pretty comfortable in your life and you don't want to do those kinds of hours and you don't have the background, and like their alternatives are 23-year-olds with an amazing idea with no risk, absolutely fully in and willing to just work themselves to the ground. That's very attractive to a VC investor because those people will work hard and they've got no backstop, right? They've got to make this thing work or that's it. That's quite attractive to a VC. If you're in the typical audience for us, you may not be attractive to a VC. So venture capital is absolutely available, but it can take a fair bit of time to raise because the investors risk losing 100% of their money on a regular basis. So They've got to be pretty careful. And so it can be a bit tricky to find a VC who's a good fit for your business. So don't let me turn you off VC funding entirely, but please don't walk into the idea of just going, oh yeah, we'll just raise some VC money and it'll be fine and we'll just get it going. It's like, it's not that easy. It's possible, but it's not that easy. So that is 14 different capital options for you to consider today. The question is, which option makes sense for you to help you fund your growth? And so I obviously can't give you the guidance on which model is right for you, but I got some questions for you that might prompt your thinking on which options might be suitable for you. First of all, what are your longer term goals for the business and how solid is your strategy to get there? Because those investors and finance are going to want to see that strategy. They're going to want to believe in it. How much do you actually need and over what time frame? Is it actually a really short term cash requirement that you've got, or is it a long term ongoing? Like, when are you going to need the money and how much, and what are you going to use it for? How much control are you willing to give up? Some people do not want partners in their business. And when you take on equity partners, they have some expectation, reasonably, because they are now shareholders, their money's at risk in being involved in some way or having a view or getting insight. You may not want that pressure. But at the flip side, they can often bring incredible skills into your business that perhaps you don't have. So how much control are you willing to give up? How much risk are you willing to take on? Is the amount of capital, some people take on far too much capital too quickly, which can be a real problem for you generating a return and being able to deploy it in an efficient enough way. So usually it's like, what's the minimum amount of capital I need to get through to the next stage? Then maybe let me worry about the next stage of financing. That's one way to think about it. Of course, you need to be thinking about what are the costs in terms of the financing options that you've got in front of you, and how strong is the history and the projections of your growth and your profitability. That has everything to do with, if you've got a low profit business, you're not going to have any banks jumping up and down to give you money because they're going to expect a certain amount of EBITDA, so a certain amount of profitability to ensure that you can cover the interest repayments. They're not in the game of taking big bets and big risks. So that's a few questions for you to ask. There is no one size fits all answer when it comes to capital structures. The best choice is always going to depend on your unique circumstances, which is why talking to a CFO, a virtual CFO, if you don't have one, there are plenty of people who will provide advice on an hourly basis and get to know your business part-time, contract, whatever you need. Your accountant, finance brokers, they can all help you understand those choices, how they work, the mechanics, and which might be best for your business. But you do need to seek professional advice. One thing I would leave you with today, I hope that's been useful for you and stimulated some questions and some ideas for you. The question for you, though, is to think about, and it was something I alluded to in those questions, is what are you actually going to show to the investor or the lender? If you're actually thinking about seriously raising capital, one of the questions that you need to be asking is how solid is your plan to get there? Because they are going to want to see that plan, the vast majority of them. Like, if I'm going to lend you some money, what are you going to spend it on? Well, you need to have a solid strategy to get there. And if you don't already have a great plan, I've got something to get you started, which is our free checklist, how to build a kick-ass growth strategy, which is available by going to seansteele.com.au/checklist. That's seansteele.com.au/checklist. It gives you a nice, easy guide to follow that will help you ask better questions if you want to build out a more solid strategy to get the most out of the next 3 years. I hope today was valuable, and I will be speaking with you next week.